So welcome to Vishwa's new podcast series. We call it Hubble. Hubble stands for Hubble Telescope, which looks really into the universe, which is what Vishwa stands for in Hindi. So today's guest will be Kenny Wu, former senior VP from Salesforce, Bo Sui, the VP of HTCO, that was the company, and Ashlan Ahmed from Axel, with the existing back payment network company in AI space. And welcome you all. And the purpose of this series is to for us both like Vishwa as a protocol and all of our ecosystem partners, early stage supporters, and industry. I'll say great people who have been or industry veterans to being not just for showing the support of Vishwa alone, but also to showcase their insights about the industry. Because as we enter a very fast evolutionary space in both fintech and others, um, I will say it perfectly aligned about the timing and so on and so forth for us to keep everything up to date, keep it very fast paced, very I'll say uh, fine learning curve about what we have been doing in this industry. So the very first episode will be actually about um, Wall Street and Web2 and Web3, everything is combined, building the resilient system after the very recent crash in the market in early October. So both Ashton and I are more like crypto background, like Bill and Denise are more like TradFi and fintech background. So this will be a great opportunity to hear the insight from both industries. So yeah, I mean, for the very first topic, I will say let's start with October 10th flash crash and the AWS outage afterwards. Although those two are like two separate topics. Both events expose how fragile.
Are they? Are they
Well, I
separate
mean,
topics?
sure. For a conspiracy theory perspective, they could be like correlated. But yeah, like I will still in public, I will still phrase it in like one financially independent and one technically independent event. So I just want each of you have your own thoughts on how were each of you affected and what did these moments reveal to you about the industry's maturity or immaturity and so on and so forth. Let's start from Denise, Jose.
Sure. Well, thank you, Nathan, and thank you for being invited to this panel and this podcast series. And excited to be here. Yeah, I think it's a very interesting question, right, Nathan? And particularly, I think if you look at the recent vulnerability, right, through the way I think of it is in terms of just both macro and maybe even micro shock to the financial system, and how that cascades into the financial system and then into the financial infrastructure is really pretty interesting, right? I think it leaves a lot of people kind of really being more aware of the vulnerability that how fragile the system really is. So I think it's a lot of people got affected, whether it's a financial transactions or just personal inconvenience, but it really highlights the need to really uh, talk about robustness, etc., but really take a broader picture in terms of what can we do to become more resilient if we're right through what is technological shock or maybe even just macro environment shock, right? So I think it tees up a really interesting conversation and hopefully direction for the future.
Yeah, thanks, Denise. What about you, both? What's your thought on this?
Uh, Personally, I've been, I wouldn't say I was on Wall Street. I did work in finance for a long time. And I did lead Wall Street teams towards at periodically. And based on my time in finance, I do say that flash crash and resilience are interdependent. You wouldn't have one without the other one. In fact, personally, I'm looking forward to more flash crashes. And I've seen
That's
some and looking forward to more.
Is that more because you short the market, or you just
Yeah,
willing to see everything crash?
yeah. When Luna crashed, I was a part of the short, um, and but I mean, it's only when you suffer these periodic um, collapses or that you have the occasion to reorganize and rebuild and establish resiliency. So you really wouldn't have one without the other one. And I would say it's the nature of capitalism. And in fact, that the U.S. economy hasn't really crashed in a long time, and that needs a good reset. So,
I
so
mean,
I'm personally looking forward to that one.
I personally agree with you. But if the industry agree with that or not, probably everyone has his own thoughts. What about you, Ash?
I agree with Bo largely. I think my language maybe isn't as punchy. I feel like if you tweeted that, a lot of crypto Twitter would just get very angry at you for a lot of that. But no, I fully agree. I think it's like, especially for the specifics of what happened on the crypto side, we're seeing stuff that people know should not happen, but then does happen, like different oracles or like price feeds that are maybe just randomly hard coded to some value or not as like robust as they should be. And it's good. It's like healthy discussions, like having protocol. Sorry, my telegram's going off. Having like protocol founders talk a lot about like what's sustainable, what's not is good. So that's on the crypto side for the like financial crash. I think it is good and probably healthy, and it's good to see this stuff out in the open. And as a company that's building stablecoin yield, for like very much like risk off, there's no volatile like asset as the base. I think it's good for my business. Like more people are thinking about stablecoins and sustainable yield sources versus like leverage on leverage and something that maybe unwinds and screws over an entire position. The AWS stuff irks me a lot. So we use AWS for a lot of our stack, especially how we sign transactions to automate stuff for users. We use their Nitro Enclaves product, which is a trusted execution environment, the same thing that iPhones use for encrypting Face ID. And it has its own black boxy issues, but when that goes down, I can't do anything for my user. So on top of like, oh, EC2 goes down or some other issue, there's like my entire product kind of goes down. And I don't think the lesson there is like, oh, it's like good and we learn. It's like a constant reminder of why maybe more decentralized provisions of services is like a good thing. But yeah, I mean, the world is kind of ran by these monopolies at some level, or these oligopolies at some level, and it's a little scary. So the crypto side's sick. The AWS side, we keep seeing this and nothing happens. I think Cloudflare had an outage, a few months ago that was just as scary for a lot of companies. Like, I don't know what the solution is. I don't know if I'm a fan of like government stepping in to break up any company. Like, I'm generally quite libertarian, but this is just like, I don't know. I don't know what the solution is.
Well, I mean, on the AWS side, it's more gonna be like not only for the backend services, because we run our ZK Lifeline on multiple servers, AWS US East 2, which is like I would say luckily enough not US East 1. Second backend node on GCP and third backend nodes on Azure. So basically, even if like the entire AWS went down, we're still safe. But the thing is that if there are a lot of centralized services actually relying on the single piece, because AWS and DynamoDB are pretty much all of those like backends and user data are stored. So if there we try to avoid single point failure on all of the design, especially for the financial system, right? So if that happens, like what Bo said, like previously, right? Are those really independent or not, right? So if you don't have, like technical sovereignty, you can't really tell that you have the financial sovereignty, right? So that's this one thing. And back to the fragility and market and infrastructure, that's specifically a question for Kenny's that you spent years scaling both fintech and AI system in Salesforce and in Oracle and so on and so forth, right? What lessons can, like those crypto builders or like the Web3 builders learn from tech company when it comes to, like building infrastructure that's truly reliable or even under stress?
Yeah, I'm glad you asked the question. Actually, while you were talking, it reminds me. Remember, not that long ago, a few years ago, Salesforce crashed. Do you
Mm-hmm.
remember that? It crashed
Mm-hmm.
for like more than a day, even, right? So yeah, and nobody thought Salesforce would crash. I think there's a lot of lessons here. I'm going to cover some of the basics and maybe some of the other areas. One is, of course, resilient and architecture. I mean, I think that's fairly obvious, but I think it's important in terms of redundancy, high availability. Also just backup, right? So I mean, it shows that there's a single point of failure. It's like somebody didn't think through and design the architecture right for that to happen. I mean, it's like, come on. I mean, it's and I think that's some of the basics. I think is it needs to be covered, if you will. But then also just the other thing is also just being able to identify, monitor, maybe even with AI, predict what could happen based on some of the activities going on, right? So if you can predict it, even if it's a short lead time, you can possibly mitigate a lot of that. And I think that that is something I think could be, I mean, could be a really interesting ripe area as you think about this. And then finally, just in terms of being able to have fast, disaster recovery. Again, these are all the basics, but it shows that, okay, so there may have been some disaster recovery, but it took a while, right, for it to really rebound. And you would think that if a crash, particularly AWS, is like, okay, it happened, but you can rebound quick, but it didn't. And it just, again, shows a lot of the vulnerability and what can be bolstered to things happens, right? Be able to prevent it or at least detect it. And if it does happen, respond very, very quickly.
Yeah, I mean, since you were talking about the risk, right? Because risk is on both the infrastructure level and also on the design level, but also from the retail perspective or from the institution perspective, it could be on the counterparty level as well, right?
Mhm.
So I want to hear both Bo and Ash's thoughts. For Bo, it's basically from the TradFi background or that perspective. What do you make? What's your make of crypto's risk culture? Like the speed, the leverage, experimentation, and what's do you feel like it's like reckless or just like reminiscence of early financial market before the regulation or all the compliance caught up?
Uh, Early days, I don't know, but I was participating in recent days, and I would say the mania in crypto is really in financial systems altogether. It's permeates the whole thing. It's just making everybody kind of manic. Um, I'll tell you a story. So I was working M&A for a long time for a large conglomerate. I was doing about $20 billion of M&A throughout my time with this particular institution. And so we were real deal junkies. So we were 10 guys, all 20 somethings. Nobody had a girlfriend. And if you wanted to grab a drink, you went down to the local 7-Eleven downstairs from the office and got the cheapest bottle of whiskey and then drank it down. And then you went back to work. Uh, in fact, there was one Friday at like about 10 a.m. I was, for the first time in some years, I had a girlfriend, and we had a dinner booked uh, involving a lot of friends. And but my boss called, and he was like, "Oh, this was in Hong Kong." So he was like, let's go to Abu Dhabi," and I was like, "When?" He was like, "Now." So I called the girlfriend and canceled the hot pot dinner, and got my passport, which was in my desk drawer in the office, and got a phone charger with a suit on my back. I went to the airport, and I was in Abu Dhabi that afternoon. For that weekend, I had to buy underwear and socks in the Middle East. I think the TradFi space is really as manic as crypto. It's just everybody's kind of in it right now. So
Yeah,
I was a deal junkie back in the day, and now everybody's a deal junkie. So
well, I mean, just like extending the TradFi's trading hour all the way to like 24/7 in crypto, right? So that's basically how we like quote unquote doing scalability, right? Not from the scalability, not only from the product perspective, but also from the time frame perspective as well, right?
yeah,
And that's for Agilon as well. I mean, since you guys are building stablecoin infrastructure and stablecoin projects, definitely managing the risk. For instance, how to say, for the retail customer level will be super important because people are only looking. Because for retail people in general, they don't really look into like risk profile because they don't know what they don't know, right? So how do you guys like manage the signals or like like shield all of the risks from all of your retail people like on the back end or like precautiously.
Yeah. Um, Yeah, I'm still rattled by Bo's story. That's crazy. It's like a TradFi really is at like a level of maniacalness that I don't think we have anything as exciting these days. Like the craziest thing that happens to us is like you stare at a chart and you see all your money get wiped out or go up. Still in front of a computer, not as much. Um, no, but
Well, the
interesting.
only thing about the underwear is that you probably lose everything, and you need to lose your underwear too, right?
And we did.
Yeah.
Yeah.
Um,
So about the same.
Yeah, I mean, on our end, I think there's risk at every layer. Like at the highest of levels, and this goes without saying, like you're not even getting any yield, even from the government on U.S. Treasuries, unless there's like some implicit risk. Like insofar as there's someone that is willing to like go and borrow against this asset, there is thus some supply APY that's attractive to somebody. So I think for us, it's like, yeah, you're right. Retail doesn't ask a lot of questions. You don't know what you don't know, but there are good comps, and I think the best comps are your bank account. Like I asked a random guy in Brazil at a conference a few weeks ago, like, why do you bank where you bank? Old guy. His answer is like 200-year-old financial institution. That's his answer. You ask a crypto person, like, why do you invest where you invest? Very different answers, right? It might be like highest APY or like, oh, I'm a big Solana bull, or even on the less, like on the more conservative side, the Ethereum Foundation themselves, we just did a call with their treasury team, and they're very, very risk averse on what they allocate to. What is Lindy? Lindy equals Aave or Compound, nothing else. And now they're starting to add on some Morpho pools, maybe like blue chip protocols that have started to handle billions and these vaults that are cool. But just to sum up the risk stack, it is like the risk stack for me and my money in Chase Bank is like you're trusting, I don't know, US institutions, you're trusting the dollar itself, you're trusting Chase as a custodian, you're trusting like bank compliance policies and like inspectors. The risk profile for like an Axel user today, you're trusting Axel itself. So is this actually non-custodial tech that's like automating what you expect? You're trusting USDC, so that's trusting Circle as like their reserves are there. Then there are new layers that you don't have in TradFi. The layers are because it's a very modular stack, and I think it's part of the beauty, but also part of the danger of crypto. You're trusting Morpho, like this vault infrastructure that allows different people to create yield sources. You're trusting curators that are managing vaults of yield strategies. So this is like a Gauntlet or an RE7 or an MEV Capital, basically just like these quant funds or these hedge funds kind of. And then there's like the underlying strategies itself, like the lending markets or like the assets themselves, the blockchains itself. Like there's risk of the blockchain itself becoming centralized or going down. So there's a different set of risk factors on our end. Automate what you can for users and try to be very, very conservative. So our bucket of pools today is like only the most blue chip like pools on base, and then we're not expanding to certain chains that maybe are newer, just because there's like a time effect there. Automations help a lot. Circuit breakers in TradFi, like use that as a comp. Have a circuit breaker for like if a yield source is too volatile. If you have something like what happened last Friday, maybe you want to, or a couple Fridays ago, maybe you want to make sure you withdraw out of any pool that's too volatile. Maybe if APY is worse than T-bills, don't invest in the pool. Like why even do that? There's undue risk that you could just get from Treasury. So that's kind of how we think about risk. I don't think there's a golden answer. Insurance is another thing where our head's been like if I pitch this to my mom or a friend, it's like, oh, is this insured? And there's no FDIC insurance for, frankly, a lot of like yield products in TradFi, but especially not for crypto. I do think my personal opinion is that Circle is too big to fail now, where if there is another USDC depegging type event, and now with the Genius Act codifying this stuff into law, like the stablecoin itself is probably fine, but we're doing our own thing with like our own insurance fund or a portion of our profits, or like there's some fun crypto protocols that are doing like shared insurance, but I think that's the final frontier on the security side or the risk side that people look for. So yeah.
Yeah, I mean that's actually aligned to what we are going to talk about next for the designing for the resilience part, right? Because for visual or itself, we really focus on anti-fragile design or like non-single point failure or a lot of redundant, like quote unquote redundancy design. I mean, it sounds a little bit dumb, right? In the sense that people may say, "Hey, you're not aggressive enough, you're not efficient enough, none whatsoever," but in blockchain, I mean, especially when it's about the programmable money, if you have single point failure, because the security of the whole system only relied on the shortest branch of the barrel, right? So as long as that single point failure break, your entire system breaks. So I mean, good. I mean, good news is that our custodial Bitcoin stay like one-to-one peg, like for our ZK proof. It's like cryptographically guaranteed. So even through the crash. So we are currently one of the only like a B35 protocol that or a blue chip asset protocol that has been remain like solid across the entire space because we know a bunch of protocols have crashed and so on and so forth because of their risk management. So for each of you guys, I'm just wondering what does true reliance mean? Because it's all about raising the correct definition and building stuff around that definition, right? So what does like true resilience mean in your domain, like from industry infrastructure perspective, product perspective, capital allocation perspective, and so on. So I will start from Kenny.
All right. So I think true resilience is where maybe I'll take it in a different angle, right? It's about ensuring the whatever you need to do, whether it's technically or financially or market wise, ensuring that the customer has faith, right? And has and feels comfortable relying on whatever the institution or organization, right? Or in this case, possibly in terms of just technology to protect, the assets that they have, right? So you have to have that level of trust and faith. So I think it's not only in terms of having resilience, but be able to convey that level of confidence to your customers so that they will continue to leverage what you have, right? So I think that one we can talk about technology a lot, but I don't think there's a whole lot to talk about. Have been conversation around in terms of how do you rebuild that trust with the customer, right? And or how do you ensure that the trust is important? I think in Vishwa case, it's like because it's so new, I think you need to be able to somehow leverage and convey that level of reliance and resilience so people continue to have faith in not only the whole crypto world but as well in terms of allocating assets via your networking.
I mean, establishing trust, there are two ways, right? Like for our progress so far, one is through like the reliable data sources, which is on DeFi Llama, right? So people can see that okay,
Mhm.
these are the amount of blue chip asset that already deploy through Vishwa, and it hasn't changed at all during this like such a volatility, like a volatile period, and that's a good way of building the trust. And the other one is since we're more like institutional focus, remaining like like how to say the mutual trust between the counterparties, as what Ashwin just mentioned, is super important, right? So I will move that to Ash to hear what your thought, your definition on your space.
Yeah, I'll go super quick. I think I touched on it a lot on the last question. I agree with what was just said. I think it's really like what you see is what you get. And the beauty of a lot of what blockchain's theoretical value prop is, I think in practice, the industry has done a pretty, very bad job at this. Like transparency and then guarantees. Like the whole point of a blockchain is like all software that's running on it, whether it's me, like just an app that's pretty top level, or like something like Visual where it's a protocol doing all sorts of stuff, lots of bridging, lots of lockups, lots of contracts. Like what you see is what you get because you can look at DeFi Llama. Because even if DeFi Llama goes down, you can look at the state of a blockchain itself. Like, I think the tech is interesting. Like, I agree. Like, tech always changes over different points in time, and like trust is built up from like not just the tech, but also like things like this, like going out there talking about things. Nothing beats time, and I think like if the beauty of crypto is like if there is an exploit, it'll be exploited immediately. Like it's almost like Aave being around for so long is what proves it's battle tested. Bitcoin and Ethereum being around for so long is the best proof. It's better than an insurance. It's better than an audit. But yeah, for us, it's like trust execution environments are very cool. There are exploits. There are issues. There's a lot that needs to be done to continue to make these things better. But like give users guarantees. Gun to my head, can I mess with your funds? Answer needs to be no. Gun to my head, are you getting what you expected? Is like what you consented to when you signed up what you're getting? Like answer needs to be yes, and just working closer towards that.
Yeah, I mean that's very crypto native. I would say that's a very crypto native answer, and that's like what we would say like quote unquote built for the future kind of answer, right? Because I mean it's talk about single point failure. There shouldn't even be a single point failure when you say a gun to your head, right? I mean even if that's won't hurt the business, and that won't hurt the environment. And what about you both? From the not just from the M&A perspective, but also from the listing company who was trying to work on something big on in this space. So, what's your perspective on the resilience? You're
Bro,
muted.
you muted.
Yeah, I wouldn't say I represent any company that's working on anything in the space. But just and I'm not going to give any comments on in the crypto space. But I think generally the startup mentality is you can be as aggressive as you want, but you kind of have to make sure that you survive another day to make it back to your investors, even as a startup. Um, I guess the key of resiliency is you stay alive and don't get reset, and you have the right mind mentality to make it back to your investors. And that's probably as the most that TradFi can probably tolerate. So yeah.
I mean, you mentioned a very interesting perspective that we haven't thought about it, right? Like the physical resilience, right? Because
Yeah.
I know in Silicon Valley, there's a very interesting culture that is prevailing, right? The Chinese style 996 culture that people sleep on the couch. They set up a corporate house. They put sofa and bunk beds in the office. They sleep around and they build everything. And like do they have like a no leisure time? They try to hustle and so on and so forth, right? But what you said is important, right? Your physical resilience is also important. If you hustle for like 80 hours per week, sure, as long as you keep yourself alive, that would be good for the investor. Because most of the VC people bet on the team, right, on the early
Hmm.
stage. And
Yeah.
suddenly, like the worst case scenario, suddenly they figure out, okay, I bet on someone who went to the emergency room, right? So that's the worst thing that the investor is willing to see, right? So definitely managing the physical health of your team member and also maintaining the I would say like either mental liveness or like like a mental resilience of the team and also the expectation of the teammates will be super important as well. Yeah, I mean that's a very interesting perspective, but going alongside the like the convergence to all of the aspect that we have just mentioned, right? Um, both on the institutional level and on the retail level and on the risk appetite, resilience, and the convergence all the way down to the building towards the future, right? So one of the last question on this podcast will be how you guys see the convergence of all three aspects and what do you envision the future of the future of construction for the whole space. I will start from both.
Um, I might have to understand that question a little bit better.
Yeah, I mean, more specifically, like when we're because we have been talking about like the risk control. We have talked about how different spaces are converging into like same narrative or like the same process of the building the risk control, not just from the philosophical level, but also from the practical level. Right? So, yeah, as the people have been working in TradFi for years, what do you envision for more specifically? What do you envision for the future of the build for not for the risk control or compliance, but also for like the technical shift and the convergence, all of those aspects.
Um, I think um, I think flash crashes will continue.
Hmm.
It's a good thing. Um, it's just investors need to be astute about their allocations, and as long as you do that and you live another day, you stand to recuperate. And and in the meanwhile, flash crashes are a matter of capitalism, is the nature of capitalism, and I look forward to more of them. And as to crypto and TradFi convergence, I think we're seeing the huge migration on chain right now, right? So, and a number of companies have a strong mandate to go crypto nowadays. So, and yeah, so I look forward to more of that. And but at the same time, I think all of these migrations will prompt crypto itself to calm down a little bit in comparison. So I guess we'll just be more like each other um, in the future. So
Yeah, I mean, you mentioned a great word about like migration, right? Because currently we see the profile. in TradFi or in the stock market, like 80% institution and 20% retail. But in crypto space, it's still 90% retail, like 10% institution, right? So um, I will say probably when all of those like off-chain assets were like more localized assets, try to move on chain or like migrate on chain to get all of those visibility and accessibility to the global liquidity. Like what you said, right? People will become more alike to each other. What about you, Kenise?
Yeah, I was gonna borrow maybe I was gonna bring up the term. I'll use the term like either guardrails or safety valves, right? So I'm gonna borrow a very old concept way back. Remember in the good old 20s when the market crashed, right? And they created a number of different guardrail and safety valves in terms of like cooling the market before it kind of continues on, right? So, and I think maybe some of those concepts could be be in parallel in the crypto and digital world, right? Where why couldn't we put on some guardrails, right? Where if a crash does starts to happen, at least you contain it while people be able to react to it, right? So just a concept, just an idea, but I think that was helpful in managing at least, it's a crash, but not a total meltdown in a matter of hours, or in this case, crypto could be a matter of minutes, right? So yeah.
I mean, in crypto, it might be hard because given the time zone differences across different countries, if everything is trading 24/7. So that's why probably in our next podcast, we're gonna cover in some like automated trading or like agentic finance based kind of thing,
Mhm.
because
Yeah.
that would be a very important topic. Because for the Binance crash recently, a lot of people were sleeping when their
Mhm.
position got liquidated, right?
Yeah.
So if
Yeah.
they don't have, the guardrail or the Kanice just mentioned, I mean, when they were falling asleep, they're still a millionaire, but when they just wake up, they need to borrow against their underwear, right? So that's that's another story. Yeah. So what about you, Ashley?
Yeah, I agree with like both these things. I guess on this point, like that, there's so much of what we're trying to do. Like even ignoring trading, just with like yield sources, like lending markets, delta neutral trades, liquidity provisioning for dexes, like all these primitives, you should have automations. Like even if the exchange itself or like the underlying blockchain maybe does not go as far as like a circuit breaker, right? What's the rule for the S&P or for the Nasdaq? I know there's some like hard coded like stock goes down or above by a certain amount, stop all trading for like a period of time.
Mhm.
Like maybe that is something that people want. A lot of people don't. That's great. Both should exist, and you can put your money wherever. Even then, it's like Axel should build these automations, and we should build these things that are catered to different risk tolerances. Like my mom maybe wants to only be invested in tokenized treasuries because she like hates most of crypto, but then she's okay with like 2% of her money in like only the most blue chip of pools, and that 2% is constantly being rebalanced as that changes. So that's point one. I think like automations are great. We'll start seeing them. You might even see it at the protocol level or the exchange level, especially as we merge TradFi with crypto. And agree with a lot of what Bo said too on like this is going mainstream. Like I'm an early stage startup, we have a long way to go, but I'm still able to talk to Robinhood and Wealthfront and Acorns and going back and forth with Morgan Stanley. Like all conversations that are like you need if you are a player in finance in any capacity, especially as like a fintech. But of course, for the banks themselves, you need to think about stablecoins. You need to think about blockchains. You need to think about like how your users can get on chain to an extent. And there's a lot of like stupid stuff. There's a lot of like let's tokenize this like thing that we can't get any demand for on TradFi. I know for a fact that one very big private equity fund tokenized like a lot of garbage kind of materials that they couldn't get demand for in TradFi, and they're like, oh, we'll get crypto people to go and have like a demand source for it. So you have a lot of crap, but then you also have a lot of just like this is more efficient, more accessible. Screw cross-border payments that take days. So yeah, I think the merger of these two worlds is here, and that's cool. Even if we do see more flash crashes, you also see a lot of more like regular people earning, like not getting screwed over by their bank, kind of.
Yeah, I would say just like what you said, right? Because people believe what they believe, and they build what they believe. They build on top of what they believe, right? Either they buy stuff or they build stuff. Like I said, if a lot of people are tokenizing their asset, right? Well, like regardless of their utility, whether they have like a real utility, because we've been in discussion to a lot of those like a regional finance on supply chain, surprisingly, right? Because we as a like blue chip asset orchestrator or whatsoever, we don't really see the on the very broader sense of the market, we don't really see those like a regional market just suddenly popped up because there are local supplier looking for like bridge loans and convertible notes and convertible debts and so on and so forth. But they try to get broader access to the liquidity providers and so on and so forth across the globe instead of like within their state, within their city, within their counties, right? So that's a lot of what those like how to say let's SMB credit unions are trying to expand their business across the line of support. So I mean, people are really believing what they're building, and people are really try to be like try to be survival, and they're in their survival mode of seeking more business opportunity and try to get alongside and converge together with the market trend, which is also it's a double-sided sword because like what Bo said, right? There are going to be more flash crush, right? Because stock market behaves more like crypto market recently as for obvious reasons, right? And when we actually have the global access to those liquidity, um, we will see that which product actually goes, like more frontier than probably the traditionally defined as a blue chip assets, right? Because U.S. bond, Treasury bond, I mean, we have been seeing like scenarios that no one is bidding the U.S. Treasury bond for like a couple of months, like from now, right? So it was like people are really seeking to what's the real definition of high credibility asset, which is what is the real definition of blue chip asset. There are a lot of transitions from like definition to definition, from scenario to scenario, from economy to economy. So, but to wrap up our podcast, definitely because this is the very first volume of our production. So definitely there could be some like crappy stuff that we talked about we haven't prepared of. We just like we try to roast people to some extent, but definitely we'll love to see like feedback from like you guys, from general audiences, from like our supporters and even people sitting on the other side of the table, like when Bo is saying, "Hey, we just want more crashes to happen so I can pick up some pick up some leftovers," right? So yeah, we we definitely want to see. The stage is for debating. The stage is for debating. The stage is ready for you guys to like showcase all of the opinions as long as it's valid, right? So yeah, looking forward to the next episode, and we're gonna cover more on the AI stuff, more on the agent payment stuff, more on the infrastructure stuff, or let's say if there are more crashes. So I mean, what I promise, like whenever there's the next crash, I will re-invite Bo to the session. All right, cool.
Yes.
So let's wrap it up. Thanks everyone for participating, and hope to have you guys next time.
Okay.
Thank you, Nathan. Thank you, Kenneth. Thank you,
Thank you.
Ash.
Yeah, nice meeting
All
everyone.
right,
Thank you.
thank you guys.
Nice meeting you all.
Take care. Yeah.